Have you ever considered the true power of banks in our global economy? Well, let's dive into it. Traditionally, we perceive banks as financial intermediaries, a bridge connecting those who want to save and those who want to borrow. They provide a safe haven for our savings. They grant us loans to buy homes, start businesses, or simply to weather a financial storm. They help us manage our money, smoothing out the rough edges of our economic activities. But here's a thought to ponder. Banks are not just service providers in the financial landscape. They are major players, influencers, even puppeteers in some respects. Their decisions about lending, investment, and risk management can send ripples across the global economy, affecting everything from the price of a loaf of bread to the stability of nations. But what if I told you the power of banks goes far beyond these basic functions? Stay tuned as we peel back the layers of this complex subject. Take, for instance, the 2008 financial crisis. This event serves as a stark reminder of the influence wielded by major financial institutions and the far-reaching impact their actions can have on the global economy. The 2008 crisis had its roots in the housing market. At the heart of the issue were major banks and their irresponsible lending practices. For years, they had been offering mortgages to customers who, under normal circumstances, would have been considered too high risk. These were the so-called subprime mortgages. Banks were not just lending to high-risk customers, they were also repackaging these risky loans into complex financial products known as mortgage-backed securities. These were then sold to investors worldwide. The logic was that by spreading the risk among numerous investors, the potential damage would be minimized. However, when the housing bubble burst, the value of these securities plummeted. The banks, investors, and ultimately the general public were left holding the bag. As mortgage defaults increased, banks found themselves saddled with assets that were worth far less than they had originally paid. This led to a liquidity crisis, with banks unwilling or unable to lend to each other, causing a freeze in the global credit markets. The repercussions were felt far beyond Wall Street. Businesses couldn't get loans to operate, and individuals couldn't get credit. Unemployment soared, and economies around the world tumbled into recession. The 2008 financial crisis serves as a potent illustration of how banks can manipulate the world economy. By engaging in risky lending practices and creating complex financial products, they were able to generate profits in the short term. However, when the bubble burst, it was the global economy that paid the price. The crisis also underscores the importance of oversight and regulation in the banking sector. Without these safeguards in place, banks can make decisions that prioritize their own interests over the stability of the global economy. As we can see, the actions of banks can have far-reaching consequences, influencing not just individual customers, but the global economy as a whole. Now, you might be wondering, how exactly do banks manipulate the world with money? Well, let's delve into the heart of it. Banks, in essence, have the power to create money. This might sound strange, but it happens every day through the granting of loans. When a bank gives out a loan, it doesn't necessarily use existing money. Instead, it creates new money in the borrower's account, expanding the overall money supply in the economy. This is the principle behind what we call fractional reserve banking. Banks only need to hold a fraction of their deposits in reserve. The rest can be lent out, creating new money in the process. This has significant implications on the global economy. By controlling the money supply, banks can influence interest rates, inflation, and even economic growth. So, as we've learned, banks hold a significant amount of power in their hands, capable of influencing the global economic landscape. To sum up the discussion, we've taken a journey through the intricate world of banking. We began with the traditional role of banks in the global economy, where we saw them as intermediaries, facilitating transactions and lending money to stimulate economic growth. We then delved into the darker side of banking, revisiting the 2008 financial crisis. This was a stark reminder of the immense influence banks hold and the catastrophic consequences when things go wrong. In this case, risky lending practices led to a global financial meltdown. Finally, we explored the manipulative power of money. We've seen how banks have the unique ability to create money out of thin air through lending. This power, when misused, can lead to economic instability, highlighting the need for stringent regulations and transparency. So next time you walk into a bank, remember you're stepping into a place that holds more power than you may have ever imagined.